Hope is not a winning strategy, and luck, it's a cruel villain because it convinces smart but inexperienced traders that they know what they're doing, right up until their account goes extinct. Let's work for a moment to actually build a strategy for consistent success. A winning trading strategy has 3 parts, and if you miss even one of them, the entire thing starts to break down. First, we must identify opportunities where strength and weakness meet. Second, once we've found the opportunity, we need a clear set of specific and coordinated actions. Third, we must protect ourselves against a failed outcome, because even on your best week of trading, we still anticipate that 15 to 20% of your trades are going to end with a loss, and we need to be sure those losses don't eat into your profits. As we determine areas of trading where strength meets weakness, it's helpful to consider what type of trader is driving the momentum. Here's a story to better understand this. Let's say you want to buy some shares of Amazon. In the stock market, you can only buy shares if somebody else is willing to sell them. So the real question becomes, who's on the other side of your trade? If it's Sir Searches a lot on YouTube with no mentorship, no structure, no plan, no strategy, and you're a longtime student of TradeSmart University, chances are pretty good that you're the strength in that transaction. But if the person on the other side of the trade is Warren Buffett, the godfather of the stock market with decades of experience and billions in deployable capital, then let's be honest, he's going to be the strength. And that leads us to an important question. How do we know who's on the other side of the trade? The answer to that question is what begins to separate trading dabblers from true performers. Think of it like this. When you get thirsty for some Amazon stock, you go to the vending machine and put your dollar in, hit the button, and out pops a bottle of Amazon. In reality, that just looks like tapping a few buttons on your phone and watching the shares appear in your account. But when Warren gets thirsty for some stock, he orders an entire cargo ship, and we can actually see that cargo ship sailing across the ocean and pulling into the harbor. But now Warren's got a problem. If he unloads those pallets of Amazon all at once into his trading account, he's going to create a massive imbalance in buying pressure. Price is going to explode upward and then crash right back down. But you don't become the godfather of the stock market by being foolish. Instead, what Warren does is load up some of the stock into his trading account and then let price settle on back down again. Same thing second time. He loads up some more into his trading account and lets price settle back down again. And so on and so forth, over and over. This leads us to an important truth about the stock market. Big money starts and ends moves, while retail money, that's you and me, either participates or fights it. Every time Warren creates one of those little price spikes, I don't want to be the guy on the other side of that trade. No, I want to ride that escalator up with him. Now, this behavior happens so consistently that there's an entire framework built around it called wave theory. It was pioneered in the 1930s by Ralph Nelson Elliott. It's an 8-wave sequence. The first 5 waves are called motive waves, and the second 3 are called corrective waves. Now, let me simplify all of this. I don't trade the corrective waves. Elliott himself said they're nearly impossible to forecast, so I don't even bother. And on the motive wave side, I don't trade waves 2 or 4. Now, that's an unpopular YouTube opinion because those moves can be fast and furious, but fast and furious is also hard and less predictable. I prefer to hang out with my buddy Warren, and Warren grinds out waves 3 and wave 5. Now, you might be asking about wave 1, and wave 1 is a good wave to trade, but it has some challenges. We often don't know it's a wave 1 until it's behind us and we've seen wave 2 complete. So let's look at this on a chart. Here's United Health Group, and notice that price gets cheap and Warren decides to buy. Price gets cheap again and Warren decides to buy, driving the price up. And as it slips on back down, Warren buys UNH on sale and drives the price up over and over again. Now, wouldn't it be great if there was a simple indicator that helped us identify when Warren and his buddies were about to buy? Now, what I'm about to show you is one of my favorite indicators, but you must first understand that this particular indication only works during a bullish trending stock. In fact, maybe rewind this video 10 seconds and listen to that again. This system works best in a bullish trending stock. That's the key. Now, my personal Buffett Buying Indicator is actually the Stochastic Oscillator with the basic settings of 14, 3, and 3. It's one of my foundational pieces for my favorite trading strategy called the Son of Benacci. Remind me to tell you sometime where that name came from. It's an amazing story. Now, I want to point out that As the stochastic oscillator during an uptrend falls below 20, that's when price starts to go back up. Price settles down, the stochastic falls below 20, and price starts to go up. It's almost like Warren is watching my indicator. I don't think he actually is, but it just sets us up really, really well for trades that have pulled back during a bullish trending stock. Now, the stochastic oscillator is just one of many tools that we can use to identify strength. Others include things like the trend direction, the trend strength, technical pivot points, maybe volume and a stock's participation with a move, even momentum and rate of change, or volatility, which I call the normalcy of a move, are all great tools. We'll cover those in another video, but for now, let's zoom back out for a second and remember that a winning trading strategy has 3 parts. We just covered part number 1, where weakness meets strength. We want to be on the side of strength. Second, now, we need to be able to define simple and coordinated actions, knowing when to enter, how much to trade, and when to get out of a trade. And then lastly, we're going to cover how to protect against failure, because losing trades aren't the problem. Unmanaged losing trades are. Everything else, all the indicators, the setups, the entries, they all plug into that framework. So let's move on to step 2, establishing your set of specific and coordinated actions. As we move into defining your actions, remember that more is usually not better. I tell my mentorship students that their strategy should fit on a single sheet of paper, and I give them bonus points if it fits on the back of a napkin. For example, maybe you're having coffee with a friend and you could scribble on a napkin, when a stock is in an uptrend and stochastic is below 20, you might consider buying. You might even draw them a little diagram around some coffee stains to help them on their way. Now, that's not a complete strategy, but it is the bulk of it. As you define your actions, you need to clearly answer a few questions. Where exactly do you enter? What triggers that decision? How much do you want to trade? Where do you take your profits? And where do you exit if something goes wrong? And whether trade adjustments are allowed. Here's an example of one of my favorite strategies. It's called the Morning Glory, and I've hidden some of the details because it's a premium strategy, but I want you to notice how simple it is. We have here the setup. We know specifically what makes a qualified trade. We have a trade trigger. We know exactly what to do and when to do it. This particular strategy is very time sensitive. On the Morning Glory, we've got 3 options for our stops. And then lastly, we have a final targeting method. This all fits on a single sheet of paper. Now, lastly, our winning strategy must protect against failed outcomes. Even the very best traders have losing trades. That's expected and managed. Now, risk management's an interesting topic with most traders. Typically, it's never considered. Some do talk about it, but never do it, and very few actually have a system. But what about this? What if risk management actually made trading more fun and profitable? Imagine for a second you're bowling. We've got a few options to manage your risk of throwing a gutter ball. The obvious is put up the bumpers. And maybe in trading, the corollary is placing less money on any particular trade or doing better position sizing. But if we continue thinking about bowling, there's some additional options that are available to us as well. They have little contraptions that let us aim and direct the ball that also lowers our chances of throwing a gutter ball. We could improve our gear, maybe the quality of our ball, get some different shoes. Why not get a bowling shirt to go with the ensemble? We could practice. All of that, maybe with the exception of the bowling shirt, improves your chances of knocking down more pins and avoiding the gutter. In trading, that sounds more like using an intentional stop, position sizing, considering your recent performance and adjusting as needed, or establishing your personal trading laws. This is my favorite. Trading laws sound like this: I will always fill in the blank, or I will never fill in the blank. Here's a few of mine. I'll always trade in the direction of the dominant trend of a security. I always want the momentum of the sector to be supporting my trade. I always want the forecasted market movement to be in the direction of my trade. And I'll never trade without a stop, ever, period. And I'll never immediately trade a security that I just lost money on. Now, to calibrate your expectations a bit, I personally only trade with a half a dozen top-tier strategies. Only the very best strategies make their way into my personal trading plan. And I do have some students that trade upwards of 10 strategies, but the point is this: you don't need tons of strategies to be successful. You need a few that perform at the highest level consistently. Strategy is the second step in the ultimate trading formula. If you want to watch step 1, check out the video in the description. And if you've made it this far, don't forget to subscribe to the channel so you can get access to upcoming trading videos and regular market forecasts.